In today's episode, I'll talk about three interesting stories. In the first story, I'll talk about SEBI's new rule for mutual funds. In the second one, I'll discuss how the German economy is struggling and what it means for us in India. And in the third story, we look at India's growth story with respect to how different states are doing. Welcome to the Daily Breed Show by Zerodha, where our aim is to give you news that is one level deeper as compared to traditional news channels. I am your host Anurag Bansal. Today is Tuesday, the 24th of September. Let's begin with the first story. See, SEBI recently announced that mutual funds can now not only buy but also sell insurance for bonds. This insurance is called credit default swaps or CDS. Let me explain what is happening here and why SEBI is doing this. See, the Indian bond market is massive. It is worth around 215 lakh crore rupees. But 75% of it is dominated by government securities. Corporate bonds make up just 22% of the market, which is very, very tiny for a country with growing ambitions as big as India's. Now, the question here is, why should you care about this? Look, if companies are not raising money through corporate bonds, they are depending on banks for loans. And while that works to an extent, it is not really sustainable in the long run, especially for a growing country like ours. What we need actually is a well-developed corporate bond market to give companies another way to raise money. But despite all the efforts by SEBI and the government, the Indian corporate bond market is pretty stagnant right now. One big reason for this is the lack of a strong credit default swap or CDS market. See, even though CDS has been around since 2011, it has pretty much gone nowhere. Now, in order to breathe life into the CDS market, the RBI made a key decision in 2022. It allowed mutual funds to sell CDS, not only just buy them. Now, before this, mutual funds could only purchase CDS and even then only within fixed maturity plans. Today, fixed maturity plans are close-ended funds that hardly anyone invests in anymore. In fact, 99% of mutual fund investments are in open-ended funds, which has made FMPs an ineffective spaces for CDS activity. But in June 2024, SEBI finally gave the green light for all mutual funds to buy and sell CDS. The hope here is that this will revive the corporate bond market in the country. But now the question is, what exactly is a CDS? Let's imagine you are a mutual fund manager and you've bought a corporate bond hoping that it will give you regular returns. But there is always a risk, right? What if the company cannot pay you back? That is where CDS comes in. Imagine it like a car insurance but for bonds. If the company defaults, the CDS seller steps in and covers all your losses. Now, why would mutual funds sell CDS, you might be wondering? Look, that is where things get a little interesting. When a mutual fund sells CDS, they're basically saying something like, if this bond defaults, we will cover your loss. And in return for taking on that risk, they charge a premium. But SEBI has put some very strict rules in place for this now. Funds can only sell CDS if they have enough safe assets like cash, government bonds, or treasury bills in order to back up their promises. If a bond defaults, they need to have enough in reserve in order to cover the losses without putting their entire portfolio in danger. So while selling CDS does involve some risk, it also allows mutual funds to diversify their strategies. Instead of sticking to only safe and low return assets, they can combine CDS sales with those safe assets in order to create investments that behave like bonds. Now, this approach lets them aim for higher returns while gaining exposure to specific types of credit that might otherwise be difficult or expensive to invest in directly. Now, the big question here is, why does all of this matter to people like you and me? See, for everyday investors, this is a win-win situation. Mutual funds now have another tool in order to manage their risk, and this could protect your money from bad bonds. Remember the time when ILFS, DHFL, and Reliance ADAG defaulted and investors lost a ton of money? If mutual funds had used CDS that time, those losses could have potentially be covered. On the flip side, by selling CDS, mutual funds can potentially make more money, offer better returns, and take on some calculated risks as well. Now, this flexibility could lead to more stable and even higher returns for investors like you and me. Most importantly though, if more mutual funds start using CDS in order to hedge their risk, it could finally boost India's corporate bond market and could help companies raise money more easily and make the market more liquid in general. Both SEBI and the RBI have been working towards this for many years now. Moving on to the second story, let's talk about how the German economy is going through a rough patch right now and what it means for us in India. See, the German economy's rough patch is not just Germany's problem. It matters to both India and the global economy. To give you some context, Germany is Europe's largest economy and the world's fourth largest economy. They account for 25% of Eurozone's GDP and they are the third largest exporter globally. Most importantly for us in India, Germany is our sixth largest trading partner. So when something goes wrong with Germany, ripple effects are pretty much everywhere. For many, many years, Germany has been known for its industrial strength. Brands like BMW, Siemens, BASF, etc. have all come out of Germany. But today, this industrial powerhouse is facing two major challenges. First, China's rise, and second, the global push for a green economy. Let me start with the first thing, which is China. See, for a very long time, China was Germany's top trading partner. But today, China is not just a buyer for them, it is also a competitor. A recent alliance report says how China has moved up the value chain. They have grabbed market share in advanced industrial sectors and are now pushing European products out of its own market. Back in 2000, China held less than 4% of the global export market, and by 2022, this number had jumped to as much as 14%. During the same period, Germany's share slipped from 10% to 8%, which is very scary. Since 2019, German machinery exports to emerging markets like India have dropped by 23%, while Chinese exports to the same regions have increased by 89%. Now, it's not just about the market share here. China is also competing with Germany in high-tech sectors which Germany once used to be a leader in. Take the auto industry, for example. German car makers were very slow to jump on the electric vehicle trend, and Chinese companies like BYD, on the other hand, are already dominating not just in China, but even in Europe. This brings me to the second reason, which is the green economy transition. See, Germany's industrial base was built on energy-heavy manufacturing and was largely powered by cheap Russian gas. But with Russia's war in Ukraine cutting off that supply and a global push for decarbonization, German industries are now struggling big time. What is important to know here is that Germany uses almost twice the energy of any other European country for its manufacturing. Without cheap gas, energy costs have shot up and have hit sectors like steel, chemical, and glass. It has come to a point now where some companies are thinking of moving production to places where energy is cheaper. The auto industry, which is in a way Germany's pride, is especially at big risk. The global shift to EVs is not just a technology change if you think about it. It is a fundamental restructuring of the entire automobile value chain. Germany's strength, which is to make complex combustion engines and transmissions, is now becoming a weakness in the EV world, which values software and batteries. Now, these are areas where Germany is lagging behind the rest of the world. Adding to these external pressures, there's also inflation. After the Russian energy shock, inflation in Germany hit a high of 11.6% in 2022, which is the highest ever since 1950s. And while it has eased a little bit since then, it is still hurting consumer spending and is putting pressure on wages. Germany is also facing a labor crisis right now. In the next 5 years, 2 million workers are expected to retire, which will leave a massive gap in a country that is already short of skilled workers. To give you a better sense, right now there is a shortage of nearly 6 lakh skilled workers according to the German Economic Institute. If this gap was filled, it could boost Germany's growth by more than 1% in just this year. And then there's also Germany's infamous bureaucracy. Getting a business license in Germany takes around 120 days, which is twice the average of OECD countries. In today's fast-paced world, this kind of a problem is a serious handicap, and all of this adds up to a tough economic situation that Germany is currently facing. Germany's economy shrank by 0.3% in 2023, and the IMF predicts that it will be the worst performing major economy in 2024, with a GDP that is set to shrink by another 0.5%. Germany has been in many tough spots before. In the early 2000s, it was called the sick man of Europe. Reforms back then helped turn things around, but this time the challenges run much, much deeper. It is definitely going to take a lot more than just some small quick fixes in order to pull Germany out of this rough patch. Moving on to the third and the final story of the day, let's understand the Indian growth story with respect to how different states are doing. Look, we all know India is doing well, but what about the states? When we talk about India's economic performance, we usually think of the country as a whole. But the interesting part is that the story really varies depending on where you are located. And that is why I thought it would be a great idea to dive into how different regions in India have done economically over the last few decades. Now, there are a lot of things to look at here, so let me break it down without getting too technical. Let me start with the regions that have been leading the charge here. These are states in the south and the west. Since the economic reforms of 1991, the southern states like Karnataka, Tamil Nadu, and the newly formed Telangana have taken the lead ahead of others. They now contribute around 30% to India's total GDP, and that is a massive leap considering these states were not always at the top of the economic charts earlier. Telangana, in particular, is a standout here because its per capita income is nearly double the national average, which is insane. Now, let's look at the western states like Maharashtra and Gujarat. See, they have been at the forefront for a very, very long time. Maharashtra even today continues to hold the largest share in India's GDP, which is around 13%. Gujarat has also been very fast catching up. Since 2000, the share of Gujarat in India's GDP has grown to 8.1%, and it is now one of the top performing states in terms of per capita income. But not every region has seen this kind of growth. Let's take a look at the north. Punjab, which was once a leader in agriculture, has now struggled to diversify its economy. Its economic growth has stalled since the 1980s, and the per capita income of the state has dropped to a number that is almost the national average. In contrast, Punjab's neighbor Haryana has surged well ahead, especially after the liberalization years. It is important to remember Punjab and Haryana used to be a part of the same state earlier, and both benefited massively from the Green Revolution. But after 1991, their paths diverged a little. Today, Haryana's per capita income is 176% of the national average, and it makes it one of the wealthiest states in the country. Now, some say Punjab's focus on agriculture might have held it back from industrial growth that Haryana eventually enjoyed. Now, let's move to the east of India, which is West Bengal. This state has seen one of the most dramatic declines. Back in the 1960s, West Bengal was the third largest economy in India, and it contributed 10.5% to the national GDP. But fast forward to today, that number has fallen to just 5.6%. West Bengal's per capita income was once above the national average, and it now lags behind at just 83.7%. Now, in contrast, their neighbor Odisha was historically one of the poorest states in India, but in the last few decades, it has seen a great turnaround, especially since the 2000s. Odisha's per capita income has now grown to 88.5% of the national average. Now let's move on to the northeast of the country, which is a region that usually does not get enough attention in national economic discussions. Now here, the star performer in a way is Sikkim. This state has gone from being one of the least developed to having the highest per capita income in the country, which is almost 3.2 times the national average. Assam, on the other hand, has a bit of a mixed picture here. A few years back, Assam's per capita income used to be slightly above the national average. But in 2010, it dropped to about 60% of the national average. But since then, it has started to improve. In 2023, it was around 75%. Now, the other northeastern states have generally lagged behind in the national averages. But states like Arunachal Pradesh and Tripura have shown massive growth in the recent years, which is great to know. Now let's focus our attention to the central part of India, where we have Uttar Pradesh and Madhya Pradesh, which are two of India's most populous states. Uttar Pradesh was once the economic engine of the country, so to speak, and now they have seen a steady decline over the last few decades. UP's share in India's GDP is now just 8.4%, and its per capita income remains one of the lowest at almost half the national average. On the other hand, Madhya Pradesh has shown some positive momentum after many decades of underperformance. Since 2010, Madhya Pradesh's per capita income has improved to 77% of the national average. Finally, let's turn our eyes to Bihar, which traditionally has had the lowest per capita income for a very, very long time. For the longest time, Bihar's per capita income was only one-third of the national average. But despite this, Bihar has shown some really good signs of economic stabilization in the recent years. Now, Bihar is no longer declining in this sense, but the gap with the rest of India still remains a little wide. So now that we've looked at all these states, the question is, what sets these successful regions apart? See, it all boils down to a few factors. 1. Economic liberalization of 1991. The southern and western states accepted these market reforms and attracted foreign investments in industries like IT, manufacturing, and services. Second is infrastructure development. States like Gujarat and Maharashtra invested in world-class port and road infrastructure, while Karnataka and Tamil Nadu developed strong IT infrastructure. Third is business-friendly policies. Gujarat and Tamil Nadu offered tax incentives, single window clearances, and special economic zones or SEZs to make it easier for businesses to set up and expand there. Fourth is skilled workforce and education. Southern states invested in higher education and healthcare and produced a more productive workforce. Karnataka, for example, became a hub for engineering talent. Fifth is global trade and maritime access. Coastal states like Maharashtra, Tamil Nadu, and Gujarat leverage their ports for export driven growth in sectors like automobiles, textiles, and pharmaceuticals. Sixth is political stability and governance. States like Gujarat, Tamil Nadu, and Odisha have enjoyed periods of political stability which allowed them for long term policy implementation. Odisha, in particular, saw a significant turnaround due to stable governance under consistent leadership since 2000. They were able to focus on industrial growth, mining, and infrastructure development. The seventh one is tourism and services. States like Kerala and Goa have had very strong tourism industries which have contributed to GDP growth. Kerala specifically has focused on eco-tourism and wellness tourism as well. But all of this was not easy across India. Several states struggled due to a combination of missed opportunities and structural issues. First, there was over-dependence on agriculture. Punjab and Bihar fell behind because they remained overly reliant on one thing, which was agriculture. And this was particularly after the Green Revolution. The second one is delayed industrialization. West Bengal's economic decline is a perfect example of delayed reforms. A state which was once the top contributor to the country's GDP pretty much missed out on the benefits of economic liberalization due to slow industrial growth. Third is political instability. States like Bihar and UP were affected by political instability and pretty much weak governance in a way. Fourth is missed opportunities in manufacturing. See, while Tamil Nadu and Telangana capitalized on post-liberalization boom, Kerala saw only very small improvements. Kerala's heavy reliance on remittances, particularly from the Gulf area, helped sustain household incomes but limited the state's focus on industrial growth. As a result, its share in GDP also declined. Fifth, bifurcation and fragmentation. See, the splitting of states like UP, Bihar, and Andhra Pradesh into smaller entities disrupted their economic trajectories. For instance, after its bifurcation from Jharkhand, Bihar's GDP share stagnated at around 2.8%. So, all in all, to sum things up, the south and west parts of India are leading our economic charge. States like Maharashtra, Gujarat, and the southern states are showing particularly strong growth. The northeast, which is led by Sikkim, is also seeing some very interesting changes, while the central part of India is starting to catch up very slowly. The north has some standouts like Haryana, but Punjab and West Bengal have seen massive declines. Bihar, on the other hand, still remains a bit of a challenge, but looking at the growth, there is a lot of hope for the future. Now, it's important to know that, as always, these economic stories are more than just numbers. They also reflect policy choices, historical factors, and global trends that shape how people live and work. Moving on to the last section of our episode, which is the small tidbits. First, recently, the Modi-Biden meeting has taken the US-India relations to the next level. They've signed agreements on semiconductor manufacturing in Kolkata, partnered up in AI and defense, and launched a $1 billion clean energy collaboration. Second, Intel pretty much missed the mark on the skyrocketing demand for AI chips. This has given rivals like Nvidia a big lead. On top of that, some of their deals, like the failed acquisition of Global Foundries, did not help either. Now, there are some reports that Qualcomm might be eyeing a takeover and Apollo Global Management could be ready to invest up to $5 billion. Third, Amazon and Flipkart are facing a Competition Commission of India investigation that could lead to hefty fines of up to 10% of their global revenue. Now, this case is in its final stages and the penalties will depend on what their financial reports reveal about anti-competitive practices. Fourth, Vodafone Idea is planning a $3.6 billion investment to upgrade its 4G network and roll out 5G. Now, while this investment is critical, it is still uncertain whether it will be enough to pull the company out of its financial troubles or not. That's all the news and stories I have for you today. I hope you found value in today's episode. I'll see you tomorrow. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.